going to go ahead and get started. Everyone's got after 6:30. I know we're waiting on a few folks, but I don't want to get chewed out for starting early. So if I do get chewed out, you guys got my back. We did not start before 6:30. So want to start by thanking everyone for coming out tonight. My name is Greg Dahlberg. I'm one of the advisors at the firm, and it's good to see all of you. This is the first time I think we've had a function since pre-COVID. So we used to hold these on a pretty regular basis, and it's always good to see you folks in the office, but it's also nice to do things other than Zoom. Zoom is okay, but we always prefer to see folks by face when we can, and just appreciate all of you and appreciate everyone for coming out tonight. We've got a mix here, I think. We've got clients. We also have some non-client guests here this evening. And again, we'd like to welcome everyone for coming out. Before we get started, want to do some brief introductions, if I could. I know for those of you that are not clients, our firm, there's 18 of us on staff that work together. We do truly work together as a team. I think that's what makes our office unique. Often, many of you know when you come in, you may see one or two of us in a meeting. You may see Brett and myself, or Michelle and I, or Wayne and Pamela, or somebody, and that's all done by design. We all do work together as a team to support all of you, and we want to make sure that all the clients know, all the advisors and our whole team that's on staff. So I'm going to take a minute and just briefly do some introductions. Everyone's going to probably hide on me here. We'll be real quick, and we'll start at the top, right, with our founder, Wayne Meyer. You're supposed to stand. Oh, you are standing. So, without Wayne, none of us would be here, so thank you. Another advisor that's been here with us a long time, Mike, maybe you can mention how long you've been here. Mike Wilcox, most of you may or may not know Mike. Mike's in the back of the room. How many years, Mike, have you been with the firm? How many years have you been with the firm? Thank you, Vanessa. So, team effort. Vanessa supports Mike. So, looks like I may need to take this out. Comes out. Not sure. You guys still here? Okay. Again, myself, Greg Dahlberg. I've been with the firm roughly 26 years. Next, Joe Meyer. Where's Joe hiding at? And Joe, how long have you been with the firm? 27 years. So another newbie. Sharon. Where is Sharon? And Sharon, you've been with us now 4 years. And then we got a bunch of young bucks here helping us old guys out with all the technology and things that we struggle with each and every day. Starting out with Logan Meyer. Logan, where are you at? Oh, right in front of me. Thanks, Logan. Adam Woolscheid. Adam is here someplace. Thank you, Adam. And then another advisor is not with us tonight. He's actually getting married, and he just left, I think, this morning, didn't he, for his bachelor party. Brett Naylor. Many of you may know Brett, another one of our young advisors in the firm. Brett, education is a big thing in our firm, and all the advisors here are fully licensed with everything: securities, life insurance, disability insurance. Education is something that we continue to strive for. Brett's not here, but I'll give him a clap. He yesterday just went and obtained his certified financial planning designation. Just went and tested yesterday and passed that with flying colors. So congratulations to Brett. So all of us that I just mentioned, we have the easy job in the firm. We're the ones that get to come and sit down and visit with you and chat and kind of go through all the news and kind of walk through all the results of the things that we discussed. But now I'm going to introduce the people that actually make the firm work. So it's not us that can take all the credit. Start with Laura Meyer. Laura's hiding. Laura, how long have you been in the firm? How many? 30. You're not old enough to be there 30 years. Pamela Perkins. Pamela works with Wayne and all of us. And Pamela, how long? You just crossed 19? 19 years, another newbie. Marissa. Jacqueline, where's Marissa? Marissa, how many years? 14 years. Amy McDaniel is where? All right, Amy, how many years for you? 19. Congratulations. Danielle Sapik, where's Danielle? Danielle supports, and we all work together, but she's supporting Adam and Sharon with everything that they run into. And Danielle, how long have you been with us now? 10 years. Another newbie. The next two I introduce, I feel bad for. These two young ladies drew the short straw, got stuck working with me. Michelle, where's Michelle at? Yeah. And how many years, Michelle?
Almost
7. And then Tammy Miller, right up front. Thank you, Tammy. And you've been with us how long, Tammy?
Almost 6.
6. And then Bridget is in the back here someplace, in the side. Bridget, how many years have you been with us?
20 years.
20 years. Everybody knows Vanessa, right? And how many years for you, Vanessa? 18 years. And then Zach, my son, right here up in front. Zach helps with all the case input, and you've been with us now 4 years. Yep, just recently out of the military, and he's been with us now 4 years doing all the case input. So that's our office in a nutshell. That's half of us. The other half of the building is full of the accountants and the CPAs, and it's tax season, so we kept all of them back there in the building to figure out how to get all of you larger tax refunds. So they are not with us tonight. So we got a couple of different things we're going to walk through this evening. I'm just going to do a kind of we're going to give a market update, talk about some changes taking place in the market, talk about some things in our office, some updates and some things we're going to be bringing on. So you will see a few of us up here tonight kind of presenting some different topics. And before we get started talking about current markets, we thought it may be good to go back just a little bit and figure out how in the heck did we get here, right? So markets here of late, I don't know if anyone's realized here in the last 5 to 6 years since COVID have been a little bit volatile to say the least. I'm going to take a quick poll here. I'm just kind of curious, and you can participate if you want, don't participate if you don't want. But curious, in the last 6 years, by show of hands, have any of you woke up one day, looked at your accounts, looked at the markets and think, this is scary, I think I want to get out? Anybody have that inclination in the last 6 years? Okay, all right, we're done with that test. Next one, by show of hands, how many are glad that they didn't? You woke up and had days in this market in the last 6 years where you're like, gosh, I'm glad I didn't make a change. We saw some big recoveries. Same thing. This market has been extremely volatile since COVID. We've had a lot going on in the world. We still do today. It changes by the second. We can't keep up with it, right? And I think if anything in the market, what we look at is this market has truly been like a roller coaster, right? In a roller coaster, you click up the hill and that's fun. You kind of go down. That's fun and scary. You get off, you didn't get hurt at the end, and that was a good experience. The stock market can be a lot like that too. When markets are up, markets are down, as long as we don't jump out of the roller coaster, typically we don't get hurt, right? And this market's been a reminder of that. So it's been so volatile. Before we kind of go forward through market updates, we just wanted to kind of look back just a little bit and give you a little history as to what's happened here. Really, in the last 6 years, I've been through a lot of down markets. If we look at, many of you may or may not remember the markets of 2000, 2001, 2002. We had 3 years where markets were just negative, negative, and negative again. We had the big financial meltdown in 2007, 2008, 2009. That's when they were talking here locally, Dow Chemicals talking potential bankruptcy. The banks had a run on Washington looking to get bailed out. At that time, the sky was falling, the markets were going to be over. And if you look at where we're at today, markets have continued to move forward, right? We can never guarantee anything in the markets, but it's going back to the saying we use a lot in the office, it's time in the market, not timing. I know a lot of you want us to think we know which days to jump in and jump out based on market moves. And if you look at what's happened here in the last 5 or 6 years, attempting to do that, could be catastrophic to portfolio returns. I want to go back a little bit just to COVID. I'm not sure if many folks really remember what happened during COVID, and some of the volatility that happened during that time frame happened so quick that many may not even know what happened. If we go back to February to March of 2020, the S&P 500 had dropped about 35% in about 16 days. Right, so a lot of us think, gosh, if markets dropped in 20 or 30% over 1 or 2 or 3 years, that's a catastrophic market. We experienced about a 35% drop in the S&P 500 in about 60 days. If you were in our office in March of 2020 and said, gosh, Greg, markets are down, we've got a worldwide pandemic going on, I just want you to tell me, are markets going to recover before year end? Right? One, I wouldn't know. I would say, gosh, first off, I have no clue. But if you're going to force me to an answer, I would have given you a bad one. I would have been wrong. I would have said, probably not. The whole world is shut down. We can't leave our house without a permission slip. Nothing's being manufactured. Worldwide pandemic. And not only did markets recover, from about March to December, the S&P recovered north of 50%. So in 2020, during that worldwide pandemic, the S&P 500 finished up about 16%, if you factor in the dividend, north of 18% for the year back in 2020. That's when nothing's being manufactured and the fear of COVID was going on. So again, trying to go time that, if somebody said, hey, I want to get out and get back in when things open back up and when there's a cure for COVID and those types of things, again, could have been catastrophic. If we kind of fast forward a little bit, go into April 2020 through December 2021, markets began to recover when we began to have some improvements with vaccines. The masses, again, COVID was a very tragic time for sure. But then when we realized, hey, it's not going to end the world, markets began to open back up, manufacturing began to resume. We had some fiscal stimulus, interest rates were low, vaccine progress was picking up and progressing, people had confidence again, things started to move, markets began to pick back up. So from really April of 2020 through December 2021, markets had done quite well. Fast forward into 2022. That's when inflation began to rear its head, and I don't know if we ever got the true numbers out of the Fed, but I would argue that we were experiencing double-digit inflation. If you think back at that time, if you're trying to go buy a TV, a washer, dryer, go buy a car, you drive by car lots they were virtually empty, right? And that's because manufacturing had ceased. We had supply and demand issues that was causing inflation to rise, and that's when the Federal Reserve decided to step in and get pretty aggressive with interest rates to try to bring down the rate of inflation back down to historical, 2 to 2.5 to 3% is kind of what that target happens to be. So in 2022, when that happened, it was kind of a perfect storm where when the Fed raised rates very, very quickly, not only was the stock market going negative, the bond market did as well. So in 2022, the S&P 500 finished down, I think about 20 or 16% roughly. There's a bond index out there. It's called the Barclays U.S. Aggregate Bond Index. The reason you and I would go buy a bond is because we didn't want to lose that money in the stock market, right? And that bond index is made up of just over 10,000 high-quality bonds. That index finished up about negative 12% that year. So in 2022, there really wasn't a safe place with stocks or bonds. Very strange time, not normal. It's because the Fed raised rates so quickly, it caused both of those markets to basically kind of collapse. Getting later into 2022 and 2024, things began to pick back up again. So we saw a lot of big names begin to recover. We saw some 40 to 60% jumps in some of the big names in large cap stocks. That's when the term AI, most of us never heard the term AI, but now it's the new buzzword each and every day. Artificial intelligence took off, and we saw some, we call mega cap, large cap stocks really begin to rally. Fast forward into 2023 through 2025, we continued to see some significant upswings and pullbacks. 5 to 10% on the regular was not uncommon. So for you and I as investors, trying to stay comfortable through all that can be a challenge. And for most of us, it's fear and greed that drives investment decisions, and our job is to try to make sure that we've got clients positioned for these types of markets before they happen. We don't want you trying to react to them during that time frame. That's like, if we've got a fire in the house and then we decide to go buy a fire extinguisher, our job is to make sure you got an extinguisher in the house before that happens. So we've seen just a ton of volatility through that time frame. Looking at 2025, so last year, volatility was no different, right? So if you remember, markets were doing okay in early 2025, and then the tariffs were announced by the current administration. When that happened, markets went backwards very quickly. We quickly saw double-digit losses in a lot of the indexes in very short order. And you may or may not remember, but a lot of the quote-unquote talking heads and experts were saying, gosh, with inflation, the tariffs in place, costs are going to go up to you as consumers, it's going to drive inflation up, we're going to go back into recession, it's going to end the economy in 2025. Did that take place in 2025? It didn't. So again, trying to go predict these things, when the current administration announced the pause on tariffs, markets came screaming back, and it happened very quickly, and I think it's on the next slide, I'll kind of show you what markets did in a single day. Markets last year, the S&P finished up, I think, just north of 24%. If you factor in the dividend it pays, the S&P 500 finished up approximately 26% in 2025, in a year in which the tariffs were announced, and a lot of the quote-unquote talking financial experts were predicting, gloom and doom and recession. Again, point being, trying to go time this stuff and speculate is extremely difficult to do, and not something that we want to try to go time and jump in and jump out based on news headlines. In fact, I think Wayne put out a letter, some of you may or may not remember, May have been about March, April, May, June last year, I do recall. In there, talked about the volatility and staying put and not certain what's going to happen. And he said, don't be surprised if we see the Dow hit 50,000, which a lot of people at that time probably would have thought, how in the heck are we going to get there with the tariffs in place? And I would say you need to get a little bit better, Wayne, because you were off by 37 days. It didn't hit it by year end, but February 6th, 2026, the Dow touched 50,000. So again, trying to go time that is virtually impossible. So work on your timing, Wayne, and dial in the forecast just a little bit better. Talking about last year when the tariffs were announced, this screen just kind of shows what can happen in a single day. Again, we watch this stuff all day, every day. And it was April 9th where the administration announced the pause on the reciprocation of tariffs. And markets rallied. Not only did they rally, the S&P 500 jumped north of 9% in one trading day. So those are returns that most of us would be happy with throughout the year. If we missed that day, it can have a catastrophic impact on returns. I think I touched base on that. So that's just a quick backdrop. We thought before we talk about current markets and what we see going forward, just with the volatility we've seen and experienced here in the last 5-6 years, again, it's not normal volatility. And again, everything goes back to the importance of planning. Those of you that are clients, we spend a lot of time talking to you about preparing for down markets before they happen, so we're not reacting to them when they do, right? And that's why we always have to have money set aside in safe places, so when we do see this market downturns, they could be prolonged. We could go through another 2000, 2001, 2002 market, and our job is to make sure we keep you prepared for that before it happens, so we're not reacting to it. Down markets, in all honesty, for those of us not taking distributions, are not a bad thing. So for folks that are still working, or if you're not taking distributions from your portfolio is paying dividends, they continue to reinvest at lower levels, we continue to accumulate more shares, so markets do recover, we've got more there to participate with it. So it's just a matter of making sure we keep you prepared for that before it happens. I think with that part, I'm done. I'm going to bring up Joe here, and I think Joe's going to have somebody come up with him. Going to talk a little bit about market trends and kind of a little bit of history again, some historical patterns.